Historically, trading on security exchanges took place through an open outcry system or pit trading, when traders wishing to buy and sell securities used verbal and hand signals to convey trading intent and acceptance. The National Stock Exchange, or the NSE, improved upon this rather inefficient system by introducing screen-based trading where quantities and desired prices are entered electronically. The Bombay Stock Exchange BSE now has a bolt system and the NSE has the neat system. The topic describes the process involved when you place a transaction and the different intermediaries involved in it. How do you buy or sell financial securities in markets? You can buy and sell government bonds, stocks or mutual funds directly from the related website through an online account or by calling a broker to execute your transaction. You will need a bank account. This is an account you're familiar with. Money is transferred to and fro from this account as you sell and purchase securities. You will also need a demat account which holds the securities you own in electronic form. The demat account is opened through an entity called a depository participant, or DP, who must be registered with a depository. A depository is an organization that holds the securities and maintains ownership records. There are two in the Indian ecosystem: NSDL, National Securities Depository Limited, and CDSL, Central Depository Services Limited. The simplest way to think about this account is that just like money goes in and out of your bank account, the securities you purchased or sold go into or out of your demat account. Both accounts are linked. Within 2 days, securities and funds are transferred to the respective bank and demat accounts of the buyer and seller. While this is all you see and care about, there is a sequence of events at the back end. As we have mentioned in the previous video, this is known as the clearing and settlement. A clearing house interposes itself between the buyer and the seller. The market regulator SEBI recognizes three such entities known as Qualified Central Counterparties, or QCCPs. They are the National Securities Clearing Corporation of India Limited, NSCCL, Indian Clearing Corporation Limited, ICCCL, and MCX SX Clearing Corporation Limited, MCX SXCCL. Clearing members are registered with these entities and manage the bookkeeping activities that clearing requires. An example: suppose you're buying 100 shares of TCS on Monday. Monday is known as the trade day or T-day, at the end of which your bank account will be debited for all the costs around your purchase. What you will receive is an electronic contract note, which is a legal document from your broker giving all the details like name of the company, number of shares purchased, price at which purchased, and applicable charges. On Tuesday, T+1 day, the processing of the transaction begins to happen. Things like matching the details of buy order with that of the seller, making sure that the funds are available in your bank account and the securities in the seller's demat account. On Wednesday, T+2 day, around 11 a.m., shares will be debited from the seller's account and you will receive it in your account by the end of the day. Money which was debited from your bank account on Monday will be credited to the bank account of the seller by the end of the T+2 day. This is what we had referred to earlier as settlement. Figure 1 offers a pictorial representation of this entire cycle. Okay, let's take you through the trade cycle when you place an order electronically on the Bombay Stock Exchange or the National Stock Exchange. The buyer places an order, a buy order, electronically, and the broker verifies it electronically. Remember, a stock exchange brings together buyers and sellers via their individual brokers. Similarly, a seller places a sell order and the broker verifies it electronically. Again, remember, in a buy or sell, price and quantity is matched electronically on the NSE. We told you earlier that the trade cycle is T+2. So on T+2 day, the shares will be debited from the seller's account and will go to the pool account of the depositories. And via the clearing members, it will reach demat account of the buyer. Similarly, by T+2 day, the bank account of the buyer will get debited and the money will reach the pool account of the clearing bank. Again, via the clearing members, the money will reach the bank account of the seller. The clearing members are the intermediaries which clear securities and the money. The stock exchange is the main party in this entire transaction, bringing the buyers and sellers, the brokers, and the clearing members all under one umbrella. From Thursday, share will be available for transactions. Some brokers have recently become willing to give you cash instantly for a higher charge. What does all this cost? The following is the list of charges levied by the various intermediaries. Note that there is some variation depending on the nature of your trading, intraday versus longer periods, and the types of securities you trade, stocks, bond, currencies. Brokerage charges, so 0.01% to 1%. Some brokerages charge 20 rupees per transaction. Securities transaction tax, stamp duty in some states. Service tax 0.025% to 0.1% of total. DP charges, flat fee Rs 10 to Rs 35. SEBI turnover charges 0.0002% of the total account. Exchange transaction charges about 0.00325%. In closing, I hope you have a good sense of what happens when you place a trade. As always, come back for more. Thank you.